Today, following the same roadmap, just like the price action roadmap, we are going to explore the roadmap of which essential topics should be studied under the smart money concept. Before reviewing the smart money roadmap, we first need to understand what the smart money concept is and why it holds significance for a retail trader to learn. Let's dive in, but before we continue, if you find this content valuable, make sure to hit the like button, and if you are new here, don't forget to subscribe and turn on the notification bell so you never miss our future uploads. I will see you right after the intro and disclaimer. Mainly, three methods are used to trade in the stock market. Whenever a retail trader enters the market for the first time, he decides his trade entry and exit by observing random chart patterns or relying on trading indicators as a shortcut to earn money. In the beginning, he manages to make profits, but after some time, due to trading without proper understanding and depending only on indicators, he starts facing losses. Because of this, many retail traders quit, assuming the market is gambling and leads only to losses, often leaving within the first 3 months. However, some traders who remain persistent and invest time in learning decide to understand the market thoroughly to recover from repeated losses. At this stage, they shift their focus towards learning price action, which is considered the most basic and essential foundation of trading. For some traders, it takes 3 to 4 months, or even a year, to grasp all the aspects of price action and apply it in trading. By reaching this stage, many retail traders manage to control their losses, but they are still far from achieving the profit expectations they had when they first entered the market. Since price action is relatively easier to learn, a large number of retail traders adopt it in their strategies. As a result, after reaching this stage, some traders remain at a slight loss, while others earn small profits. Yet, they remain dissatisfied because their vision is much larger. Now, you are starting to see how trading works and how the market reacts, gaining some understanding of how operators trap retail traders. Until now, you have been approaching the market with the mindset of a retail trader. But if you want to transform into a consistently profitable professional trader, you must learn to think like an operator, understanding how they strategize, how they trap retail participants, and how they generate profits. To explain this further, let me give you an example. This is a 5-minute time frame chart. Here, as soon as the market opens, the price moves downward, forming a bearish price action like this, after taking support at the lower levels around the previous day's closing. It creates a double bottom chart pattern, which some also refer to as the W chart pattern. Now, observing this price action, many retail traders think the market has bounced twice from this support, which indicates that the price may reverse upward from here. With this belief, as soon as the price breaks out of this pattern and begins moving upward, traders enter a long position by placing their stop loss just below this large bullish candle. Additionally, some traders prefer waiting for a breakout above the resistance zone before taking their entry. After some time, the market breaks through this resistance as well. Seeing this move, traders who missed earlier entries now rush into long trades at the breakout. However, shortly afterward, the price drops and triggers the stop losses of all these retail buyers. On that day, many of you might have experienced losses at this exact level. If you also faced a loss here, do comment below. But if you had understood even just 2 concepts from the smart money framework, inducement and liquidity grab, you could have avoided this loss. Let's break down how. This chart displayed a one-sided bullish rally of nearly 400 points, which provided solid profits to retail traders who entered on the bullish side that day. However, on the following day, when the market opened with a gap up and then gradually began moving downward, many retail traders assumed, since the market already rallied 400 points yesterday, today it will definitely fall from here. With this expectation, they started taking short trades. At the same time, there was also a psychological resistance level of 25,000 on the upper side. As the price began to decline, some traders entered short positions, placing their stop losses here above, while others placed them in this zone. But as soon as the market took support at this level and started moving upward, fresh traders entered long trades, placing their stop losses here below, thinking the bullish trend from the previous day might continue from this support. Now, If you observe carefully, stop losses of retail traders are positioned on both sides, above and below, which means maximum liquidity is concentrated in these two areas. Once the price moved slightly upward, the stop losses of the traders who entered short began getting triggered, forcing them out of the market. This reduced liquidity on the upside. To take advantage, operators create such fake breakouts on the chart, tempting retail traders, a setup known as inducement in the smart money concept. Seeing this breakout, many retail traders rushed into long trades, placing their stop losses below this resistance. At this point, operators now had enough liquidity to place their sell orders and push the market downward. By capturing this liquidity, the price dropped sharply, hitting the stop losses of all those new buyers. By showing a false breakout, operators exploited the psychology and mindset of retail traders. That's it, traders. Thanks for watching this video. Every major journey begins with a single step, and today you've moved one step further. If this video brought value to your learning, don't forget to hit the like button, it really makes a difference. And if you're visiting for the first time, subscribe and be part of a community dedicated to learning, growth, and success together. Thanks for watching, and I'll catch you in the next video.